tech stocks have been outperforming quite a bit this year as investors flock to the sector amid more rate hikes and bank turmoil. Our next guest, though, believes that the beaten down areas of the market need to catch up for stocks to stage a meaningful second quarter rally. Joining us now is Ed Clissold, Chief U.S. Strategist with Ned Davis Research, and Ned Davis Research, excuse me. And Ed, it's great to catch up with you. Thanks a lot for coming on. Boy, this split market has been pretty conspicuous. We've been talking about it for a week or two here. How do you think it resolves? I mean, do we take heart in the fact that investors have been rotating toward perceived safety, or is a narrow market a dangerous market?
Well, I think within equities, a narrow market is a dangerous market, because then if those few companies that have been rallying run into trouble by themselves and there's nothing left for the market to hang on to. But I do take heart in that investors have not left equities as a whole. They haven't abandoned the stock market. So there's a possibility they could rotate back in. So, for example, you don't want to see what we call multiple 10-to-1 down days, where all the volume of stocks were down in the day were more than 10 times the stocks that were up on the day. That only happened once, a couple Thursdays ago, when the Silicon Valley Bank news first broke. Besides that, it's been more of a rotation. So what we want to see is a rotation back into some of these areas that have been beaten down.
And I know you do a lot of work trying to characterize what sort of market we're in, whether it's bull or bear market, what kind of moment in the cycle we might be at. You know, if you go back 10 months, the S&P 500 has been very, very sideways. It's been hard to really say that it's done much in either direction, although we are up off those October lows. And there was a lot of excitement in January, and you looked at it closely about how broad the rally was. And you had industrials and material stocks and cyclical things leading. And it seemed to prompt a lot of people to say, you know what, October could have been a very important low. We might be in a no bull market. Where do we stand on trying to figure that out?
Well, we're going through a testing phase. And in fact, if you were to just say maybe October was the start of a new bull market, this is about the time in the rally you tend to get a gut check. Now each cycle is a little different. It may not be a bank failure, one cycle, but this is where you'd expect it to happen, Michael. And at this point, you haven't seen enough broad technical damage for that to take place. And also, I'd add that a lot of times the first scare really brings out a lot of the people who were nervous. And you've seen that from a lot of sentiment data showing that people have been skeptical. Again, that's a positive sign that the market is working through this information. And of course, the big caveat is you can't have a lot of bank failures. This is ring fenced within the banks so far, then
Sure.
that would be a positive development.